Hello and welcome to Macrobytes, the economics and politics podcast from Aberdeen. My name is Paul Diggle.
And I'm Luke Bartholomew.
Is the US still economically exceptional? Is it the city on a hill that has a higher GDP growth rate, more technological innovation, the world's biggest and best companies, which provides the global safe asset and reserve currency? Well, financial markets have started to question the notion of US economic and market exceptionalism. That's the topic we are going to dive into on the podcast today. And I think the place to start, Luke, is by unpacking this notion of US exceptionalism, because as I was hinting at there, it can take a lot of different forms. I think the most straightforward version of economic exceptionalism is having stronger economic growth than the rest of the world. The US is, of course, the world's largest economy, depending on exactly how you measure it. It has the highest per capita GDP of the very large economies, and it has an average growth rate which is pretty high. Over the past 5 years, so a period that would include COVID shock, but then the rebound, so averaging through that period, US GDP growth has been 2.4% per annum. And that is substantially higher than Eurozone growth averaging 1% over that period, UK growth averaging 0.9%, Japan at 0.2%. In fact, 2.4% looks a little bit more like some emerging market growth rates. India above 5%, China 4.8%. It's actually stronger than growth in Brazil or Russia over that period. And US economic growth outperformance reflects its economic dynamism, having a more flexible labour market structure, more business-friendly regulation, having a more supportive but maybe unsustainable stance of fiscal policy. I think over the past 5 years, certainly, it reflects the handling and then recovery from COVID. US policymakers prioritised maximum labour market flexibility, which saw the unemployment rate surge higher, employees supported with direct cash handouts from the government, but then allowed the reformation of labour market matching as the recovery from COVID began, that perhaps adapted to the new structure of the labour market and economy, the more goods-intensive structure that emerged subsequently. And that was contrasted with European furlough schemes, which perhaps were less flexible in their nature. And if you go further back, US growth outperformance reflects the handling and then recovery from the global financial crisis. More flexible labour markets, a painful but ultimately helpful bank recapitalisation in the US, more monetary stimulus, less fiscal austerity. All these things, I think, have played into relative US economic outperformance.
And then the second piece of US exceptionalism, and perhaps the one that's most well known to financial market participants, has been the ongoing outperformance of US risk assets compared to the rest of the world. That cumulative total US equity market returns have essentially beaten all comers over many multi-year horizons, certainly over the last 5 years or so, but going back all the way to the financial crisis as well. The US equity market has just been the standout outperformer across global developed market equities. And that's partly related to some of the things that you were talking about, Paul, the dynamism of the US economy, perhaps related to a better policy response as well. But I think perhaps the most famous or archetypal way of getting at this has been the dominance of US tech companies' leadership across AI, most famously the Magnificent Seven companies, that the US has been home to extraordinary tech innovation. Its companies seem to have enormous corporate moats. That is, this idea that they had a durable competitive advantage provided by business models or corporate positioning or something like that. And that's what made the US home to some of the biggest, most important, seemingly most exciting companies in the world. And that's why investors wanted to be there, and they were rewarded, as I said, with extremely high returns.
Yeah, and the result of that, of course, has been the US has been the destination of choice for substantial amounts of global capital flows. Net foreign purchases of US equities over the whole post-financial crisis period are substantially positive. The US runs a large capital account surplus. That is to say that foreigners are sending a lot of capital to the US, investing physically in the US infrastructure, but also buying financial assets in the US. And that capital account surplus is, of course, the mirror image of the current account deficit, the trade deficit, which the current administration is so concerned about. And then lots of institutional fund managers, global investors talk about being overweight US assets. Now, I'm always a little bit dubious of this concept because, of course, for every buyer of any asset, there must be on the other side a seller. So the world can't be in aggregate overweight or long any particular asset. But I think it is the case that the size of price appreciation that you were talking about, Luke, in the US relative to the rest of the world means that US holdings are just a very large part of most global investment benchmarks now. They make up a large share of many investors' portfolios.
And then the final piece of US economic exceptionalism, and it's also tied up with geopolitics, and it's an expression of American power in the world, and indeed a source of that power, is the fact that the US issues the reserve asset, treasuries, and the reserve currency, the US dollar. And we've talked about that concept many times on this podcast before, but to recap, for many people, this is a so-called exorbitant privilege. It gives the US lower yields, lower government borrowing costs than they otherwise would have, because there's this extra demand for treasuries as a reserve asset above and beyond simple economic reasons for owning the asset. And in particular, in crises, yields on government borrowing, government debt in the US tend to fall, and that can be an important stabilizing mechanism. On top of that, the dollar also tends to appreciate in downturns, in crises, even if those originate in the US. And again, that can be an important stabilizing mechanism. And the third thing, as I alluded to there, is that reserve status gives the US extraordinary foreign policy power. They're able to leverage control over the global financial system to achieve various foreign policy objectives through sanctions and the like. But as we've also talked about on the podcast, some people actually increasingly see this as maybe as an exorbitant burden rather than privilege, that, as you were talking about there, Paul, the capital inflow to the US has as its necessary counterpart a current account deficit and a stronger dollar to make that happen, and that's tended to squeeze out the manufacturing sector, which some people think of as being politically and economically undesirable given the consequences for inequality, regional economic development, and perhaps for long-term strategy and geopolitical competition as well. But I think one other thing to note about this kind of exceptionalism, the reserve asset exceptionalism, is that there is no necessary connection between that and the other forms of exceptionalism that we were talking about, growth and financial market outperformance exceptionalism. In fact, there might be a bit of a theoretical and historical puzzle, or at least a bit of a surprise in that, because for sure, the reserve currency issuer would typically be the most important economy in the world with deep, liquid financial markets. But there's no need why that has to be associated also with the best growth prospects in the global economy. In fact, you might think that the most exciting growth places are not going to be in super developed leading economies. They're actually going to be in emerging markets that need to do catch up growth, that's where capital can be most efficiently employed. And in a sense, that's kind of what happened during the 19th century British imperial history, because the UK, the British government, was the issuer of the reserve asset, the safe asset, but it was not the home of the most exciting, attractive returns. In fact, the UK was a net exporter to capital, to various British colonies, and indeed, frankly, the US as well, as those were the most exciting places for growth. So, yeah, in a sense, perhaps the truest expression of US exceptionalism, up to this point at least, is that it has been able to be at the same time the issuer of the safe asset and also the issue of the risky asset of choice, that in a sense it's given investors in the US a chance to have their cake and eat it.
Great. So that's the different forms that US exceptionalism can take. But let's talk about some of the threats to US exceptionalism, because these two span a spectrum of different types, from the near-term cyclical growth deterioration that may be about to get underway, through to the US being a structurally less attractive destination for capital, and then in extremis, that the dollar may lose its status as the global reserve currency of choice. Treasuries may lose their status as the ultimate safe haven asset. And that spectrum looks, I think, progressively more serious, perhaps progressively less likely. But let's take each in turn. The immediate challenge is that the near-term US economic growth outlook is deteriorating. We, Luke, like many economic forecasters, have been downgrading our US growth forecast. The US grew 2.8% last year, as I said, 2.4% over the previous 5 years, and we now expect it to grow by 1.3% in 2025. Now, I sometimes like to joke that economists include decimal places in their GDP forecasts and their numbers to show they have a sense of humor. So don't take that 1.3% too literally. But the point is that the US economic outlook is deteriorating, and perhaps only just starting to deteriorate in the growth data. We'll learn more about that in coming weeks and months. That would still be stronger than some other DM economies, 1.3%. We'd be making downgrades elsewhere, but they're probably largest in the US. It's not a negative number. It's not recession in the base case. There are still some tailwinds to come, perhaps from tax cuts, perhaps from deregulation, giving the economy a bit of a fillip. But there are still actually substantial recession risks too. There might be close to 50% if the high point of the US weighted average tariff rate is not yet being seen. If tariffs rise again, if the reciprocal tariff pause is just that, a pause, and they come back on, if business uncertainty, consumer uncertainty remains exceedingly elevated, I think it's quite plausible to see an economic recession in the US. And that would be coming alongside an at least temporary rise in inflation, as well as tariffs raise prices. So it's a stagflationary combination into which the Fed is going to face some policy dilemmas. I think the Federal Reserve will still be cutting interest rates a couple of times this year, more next year, but it may start that process more slowly than otherwise, given the inflationary threats as well.
So let's move along the spectrum that you were laying out there, Paul, and move on to the second challenge, which is that the US is perhaps becoming a structurally less attractive destination for capital. And I think in turn, this has several parts as well. And the first is the idea that potential growth in the US might be lower. You were, of course, talking about growth in a cyclical sense just there, recession, yes or no, and certainly tariffs, trade uncertainty do have economic consequences over that kind of time horizon. But I think where the consensus around how trade policy really gets its economic bite is over the long run and the impact that it has on potential growth. And I think there is a pretty clear consensus that increasing protectionism leads to lower potential growth because there's less gains from trade, less gains from comparative advantage and the efficient allocation of economic resources and capital. There's smaller economies of scale to be reaped. There's less competitive pressure, and so in turn less economic dynamism as firms can hide behind these protective trade barriers. And so if US exceptionalism was in part a story of its potential growth rates being higher, and this is weighing on US potential growth, presumably that must be in some senses also eroding that US exceptionalism. Now, of course, it is important to stress that that might be a perfectly reasonable policy choice to make, that you are trading off efficiency for maybe greater resiliency, or maybe to protect particular industries that you think of as being especially politically or strategically significant. That is a perfectly reasonable political choice, but it is just that, a choice, and it has trade-offs, and that trade-off is lower potential growth. And then the second way in which the US might be becoming a less attractive destination for capital is that policy uncertainty, which has been, of course, extremely high recently, might be just a permanent feature, or at least a long-lasting feature, of the US economic backdrop. We have, of course, still 4 more years of President Trump to go, and the way in which policy has been set so far in this administration suggests that policy uncertainty is going to remain extremely high, just around the way it is that decisions are made in the administration, and the sense in which there can be relatively quick reversals on policy. But also more fundamentally, perhaps Trump has introduced a governing style which involves a more forceful executive and a more pliant legislature and judiciary, and that introduces more uncertainty as well and more risks around the way in which policy will go. But even looking beyond Trump, I think you can make an argument that there are some structural changes to the US political environment in general that should make policy uncertainty higher. And in part, those are somewhat related to Trump. Maybe there has been institutional degradation in the US. Norms have been eroded. And so as Trump has behaved, perhaps his future political successors from either party might behave as well. And then on top of that, perhaps there's also been this greater political polarization as well, which has also had the effect that the stakes seem to be higher at every election, and the possibility of big swings in policy is that much greater. To put it in a way that it's sometimes expressed, the so-called Overton window is wider. This is the idea that at any one time there's only a relatively specified, quite narrow band of policies that are imaginable or permissible in the current political order. And as that window has seemingly got wider, the range of political outcomes that could flow from any election or change in government has got bigger. And so there's greater uncertainty around that. Now, it is worth saying that another way of saying a greater premium needs to be put on US assets because of this uncertainty is also to say that the expected return has to be higher as well. The premium is just a way of generating return, and that return is necessary to compensate for the risk. So in equilibrium, in steady state, perhaps expected returns on US assets will look higher. But two things to say about that. First, as I say, that is to compensate for the risk. It's not like it's a free lunch. And the second, that the way in which that premium gets built in to US asset prices is that asset prices have to fall, or at the very least perform less well. And so that's another way in which this exceptionalism of very strong US asset market performance may now be fading.
Yeah, and another way in which the US could be becoming a structurally less attractive destination for capital is that the corporate moats that you were talking about, Luke, the durable competitive advantage that large US firms, especially technology firms, have, could be narrower and shallower than the market previously thought. Markets had previously thought that things like network effects or economies of scale, the size of capital expenditure required to purchase and build the GPUs, the chips that were involved in training large language models, that these created such large barriers to entry that those particular firms' competitive position was secure. But developments such as DeepSeek, the Chinese AI model, which has been developed at considerably less expense than US counterparts, using a generation or two behind the bleeding edge of chips, by using innovative algorithms and techniques, things like system of experts, which is a way of training a large language model which is less computationally intensive, that development has shown that US corporate moats are shallower than previously thought. Pre-Trump, during the Biden era, people also worried about threats to US tech firms from regulation, antitrust, from possible breakup. I think those could still come back at some point as also ways in which corporate America's moat, its durable competitive advantages, could be smaller than previously thought. Okay, but let's move on, Luke, to the biggest challenge to US exceptionalism, which would be if the dollar were no longer the global reserve currency, and if US Treasury bonds were no longer the global safe asset of choice, the ultimate form of sort of protecting your money, insulating it from risk. And I think the way that a threat as profound as that could develop would be that US policy uncertainty gets so deep that it verges into meddling in the institutional architecture itself, the set of economic policy institutions that are the foundation stones on which having the dollar as the reserve currency, having treasuries as a safe asset are built. And certainly some of the financial market price action post-Trump's tariff liberation day look like price action that's starting to contemplate that risk. There were days, painful days post-liberation day, when US bond yields were moving higher, i.e. bond prices were moving lower, US stock prices were moving lower, and by more than in the rest of the world, and the US dollar was selling off against other currencies. And it was sort of a so-called sell America trade or set of correlations was developing in financial markets. And that's a set of correlations that look a little bit more like an emerging market having crisis, a currency crisis or a balance of payments crisis, than it looks like the correlation structure of the provider of the global safe asset.
And whilst I think no one in the Trump administration wants there to be a currency crisis or anything like that, I think it is worth saying that for some policymakers, the idea that the US reserve status is going to be eroded is a feature, not a bug, that's actually part of the intent, not an unpleasant side effect. I've talked already about how there is a growing sense among some economist policymakers around Trump that the US reserve status is an exorbitant burden, not a privilege that needs tackling. And we've discussed on the podcast before the so-called Moran Plan, Stephen Moran's paper. He's now chairman of the Council of Economic Advisors in the Trump administration, ways to potentially tackle, as he sees it, some of the issues of US reserve status. And some of the things that are talked about there would involve really quite profound upheaval to the US Treasury market and the way in which reserves currently exist within the global financial system. He's talked about so-called user charges on overseas holders of treasuries, and that's just a fancy way of saying tax, to be frank. So an extra tax on US treasuries. The other thing that's sometimes talked about is effectively forced debt swaps. So existing US government debt would be swapped by the administration with perhaps century-long bonds. So the US debt is termed out, and presumably it would be termed out at an interest rate that is below market interest rates. And it's quite difficult to look at either of those two things and not think that they rather smell of default. And again, given just the vast importance of treasuries in the global financial system, even if you think that doing something about US reserve status is a feature, not a bug, I think you ought to be somewhat concerned about some of the other bugs that might spread across the global financial system. It is potentially profoundly systemically damaging, I think.
Yeah, and another way in which the US institutional architecture could be threatened changing, in addition to treasuries, Luke, is that threats to central bank independence, the Federal Reserve's independence, have been increasing under Trump. Now, Trump's, of course, launched scathing rhetorical attacks against the Fed and Chair Jay Powell, as he did during the first term, but these have stepped up during the second term. He's put up posts saying that Powell's termination cannot come soon enough. Now, he has since rolled back a little bit and said that he has no intention of firing Chair Jay Powell, that he will wait until his term is up in May 2026. I imagine that Treasury Secretary Scott Bessent has had some words with Trump and explained the potential dire consequences of directly interfering in Federal Reserve independence. Trump may just be preemptively shifting the blame for the coming economic slowdown from the administration's tariff policies onto the Federal Reserve. But what gives these attacks particular bite, I think, is this court case currently going through US court system to be considered by the Supreme Court, Trump v. Wilcox, it's called, where it's going to test the president's ability to fire without cause independent federal officials. It will test a ruling known as Humphrey's Executor, which had previously protected independent officials from the whims of the executive. And if that ruling goes Trump's way, which is quite possible, there'll be a ruling likely before the summer recess. If there's no specific carve-out protecting Federal Reserve and FOMC officials' independence, that could, I think, give Trump ammunition, should he wish to use it, to fire Powell, to really step up intervention in the setting of monetary policy. And that would take different degrees. We're at intense rhetorical pressure tick. We could move to having a stooge, a sort of Trump lackey in place at the head of the Federal Reserve, whether it's by firing Powell or just by replacing him when his term is up as chair next year. And it could go all the way through to replacing the whole of the FOMC, the Fed's rate setting committee, or just bringing interest rates directly under presidential control.
And then the risk of over-harping on about this Moran plan, or perhaps even to suggest that there is more of a plan than is really going on. But nonetheless, I think it is worth stressing that there are aspects of that so-called plan that would require, if they were implemented, a whole-scale restructuring of the role of the Fed. So, if the administration really does want to bring about sustainably lower dollar, and perhaps to do that via agreements with other countries, the so-called Mar-a-Lago Accord, it's almost certainly the case that would require monetary policy coordination as well. The Fed would need to be involved in that and set interest rates and monetary policy more broadly in a way that brought the dollar lower. And it's quite possible that would not be consistent with its current dual mandate for full employment and a stable price level, which it interprets as 2% inflation. It could be that kind of policy would lead to inflation consistently above 2%. And so, as currently constituted, an independent central bank wouldn't be able to do precisely the currency policy that might be required of the plan. So if we take the plan seriously, perhaps we should also take the idea that central bank independence needs to change seriously as well. Yeah,
and taking it further still, one could worry about the US the Fed ending dollar swap lines, which has provided dollar liquidity to other central banks during periods of acute liquidity crisis. They've been rolled out in financial crises in the past. If the US really wanted to push this line of rewriting the rules of the global financial system, that could be another place to go. Look, I think ultimately, Luke, the end of dollar reserve status, the end of US Treasuries as the global safe haven, is probably a little bit of a straw man. There are very powerful network effects which come together to create the dollar's status as the global reserve currency. There's a lot of inertia in the system, which means that it's very costly to move away from a sort of global dollar standard. There's a lack of alternatives. China doesn't run an open capital account, doesn't issue enough debt to the rest of the world to be able to serve as the provider of the global safe asset and reserve currency. But global reserve currencies come and go over the long sweep of history. Their status is often linked to the global military and economic hegemon. And we are in a position, in a period of transition from a unipolar to a bipolar global economy. And over a long period of time, that is going to come, I think, with a gradual shift away from the dollar, from treasuries, and the gradual erosion of US exceptionalism.
Well, with that gesture to the grand sweep of history, I think that is all that we have time for this week. So, as ever, please forgive me if I ask you once again to like, subscribe, wherever it is that you get your podcasts from. And then all that remains is for me to thank you all for listening. So thanks very much, and speak again soon.
This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment, recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns, return projections, or estimates, and provide no guarantee of future results.